We've had 3 years of the market fairly going straight up. It's been a few years since we had a bear market. Now, 3 years in certain perspective is not very long.
If you're standing at the starting line toward retirement, and I mean, 1, 2 years away from no longer working, you're not only planning for financial change, but an emotional one too. And you may be having a stronger reaction to the market's ups and downs than you have before. So today, we're unpacking why this stage feels so intense and what you can do to feel more in control. Hello, and welcome to Money on Your Mind from Edelman Financial Engines. I'm Michael Liersch, a behavioral scientist, financial planner, and chief planning officer at EFE. Thanks for joining us for a conversation about how people are feeling about money, what they're wrestling with, and how financial planning can help you straighten things out. Today, we're talking with one of my favorite human beings on the planet, honestly, Mark Palmer. We've only known each other for how long, Mark? Have we known each other for?
It's been 6 months or something, 4 months. I don't know, whatever it's been.
Yeah, I mean, but we've taken long car rides together. You've circled around the airport with me trying to find hotels. Does that sound about right?
That sounds about right.
Yeah, we've had dinner, we've hung out. So it's been a really great journey with you, Mark, and it's been great getting to know you. You're a financial planner who's passionate about clients, passionate about helping them, and I know you're passionate about this particular topic of 1 to 2 years out from retirement. How you can help, and we're going to help our listeners think through that today. So, Mark, welcome to Money on Your Mind. I just want to tell our listeners, you're an attorney. You've passed the bar exam. Maybe you can tell us a little bit about that journey.
Sure.
And you've been a planner for well over a decade. Tell us a little bit though about yourself. You have these great credentials. You're a fantastic professional. Tell us a little bit about who Mark is on a personal and professional level.
All right. Sure, Michael. It's great being here with you. Yeah, I spent a lot of time in school. Maybe I spent too much time in school.
No.
So I've got the law degree, as you mentioned. I've got a master's in international finance. But interestingly enough, I really didn't end up formally going into either of those paths. I ended up in finance. And one of the beautiful things about this area of finance, of financial planning, is that unlike some of those other areas, I really feel like I get to help people. And that's very rewarding. It's what I love doing. And so that's why I'm still doing this after, let's not count the decades, but it's in more than 2 decades. So that's really kind of my path through this. And I've been with Edelman now over 10 years. And so that brings us here today to this.
And what I was trying to help you out, Mark, by saying it was over a decade, and now you already told people it's over a couple decades.
Okay, you can tell from the gray hair. It didn't start out gray when I started here, but it is basically now. So, yeah.
Well, it's great to be here with you, and I'm happy that you're going to be sharing your wisdom. And now it makes sense. We actually really haven't talked a lot about that idea of maybe our joint passion here is the idea of helping people. And our listeners know, that's my passion point, Mark, and why we do the podcast, honestly. So I'm really glad you shared that. So in that spirit, when you think of this category of human being who's 1 or 2 years away from this moment of no longer working, all the decisions they have to make, tell us a little bit about what you're hearing from your clients, from just people in general about this moment. What kind of questions you get? What kind of concerns do they have? Let's normalize that a little bit.
Yeah. So I'll start off by saying, to be fair, there are many people, some people that going through this have no concerns, do it smoothly. It's like nothing's changed in their life. That being said, I find that many people look at this and are experiencing it as a major change in their life. And a lot of that is emotional, rather than going to work and doing a certain set of things in a day, having your social structure there, your relationships at work, all of that's being thrown up. And sometimes those people maybe don't even have a list of things they're going to do when they're retired, whereas others may be busier retired than they were when working. And so that can be very common both directions. For a lot of people, finding your spot in life is fun and exploring, and sometimes that's emotionally challenging as well. It can also be financially challenging. And one thing that changes that's pretty dramatic is that if you think about it, maybe for a few decades, when you thought about your income, you looked at the stability of your company that you worked for. How well are they doing? Are they a startup that maybe didn't get us another round of finance? Or are they a large company that you're not going anywhere? You looked at the company for your income to make sure that you're going to be okay.
Or as a
And then,
business owner, right, Mark?
sure, a
Like,
business owner could change, all sorts of stuff could happen. But then once you shift into retirement and you start to rely on all the savings, the portfolio you've built up after all this time, all of a sudden people start to maybe look at their portfolio for its stability, or how likely is it going to be providing that income over time. And that can be a shift. Maybe you didn't look at it that much before. Now, maybe you're looking at more often. This can be a good and a bad thing. It just depends on how you kind of work your way through that all, and what choices you make as you go through. So those are some of the key elements that I think can be challenging for people. That being said, there's actually some unique risk at this stage that one needs to think about. And one of the most best understood ones is what's called a sequence of returns risk, or
okay.
really it should be called a bad sequence of returns risk, because if you have a good sequence of returns, you can actually be better than planned, basically.
It's like the word volatility, right? It's
Yeah,
really a code for markets going down, right?
yeah, everybody likes volatility going up, volatility going down, not so good. Well, what is bad sequence of returns risk? Well, you can look at long-term averages and say 1 out of 4 years is negative, 3 out of 4 years are positive in the market. That's why it's going up over time in the long run. But theoretically, you could have a series of negative returns years back to back. And even though later on good markets average that back up and offset that, because you just started retirement or relying on your portfolio, you could irreparably damage your portfolio, your plan. This is something that one needs to think about and
So let's dig
address.
into that a little bit, Mark. Because
Yeah.
so when you're talking about sequence of returns, to your point, you have this look back where on average, things have gone up. But what I hear you saying is if you're 1 to 2 years out, people are talking about potential recessions or a market drawdown. What you're saying then is people might be, or what you're hearing from people is they might be concerned that right when I'm going to be retiring, that's exactly when the markets are going to go down. And so then if I have to pull out money to live my life, effectively that money's not going to actually recover because I've had to take it out of the markets and spend it. Am I hearing you right?
Yes, and that can have two major impacts. One, it can actually damage the portfolio.
Okay.
Even if you're set up in a way where that's not going to, emotionally, that can be a big hit, because what do we not want to do as soon as we've given in our resignation? Have to crawl back to that manager a year, 2 years later and say, I need a job back,
Give
right?
me a job,
So the
please.
concern or fear around that is reasonable. Look, I always apply Murphy's Law to myself, because I tell you that, look, when I retire, that's what's going to happen. The market's going to go down right afterwards. Well, so I'm going to make sure that I'm very much planning for that and try to do that with clients as well.
Tell us a little bit how you plan for that. Do you just say, to your point, apply Murphy's Law and say, well, it's going to happen to me, so it's just too bad, and I just deal with it emotionally? Or is there like something you can do specifically from a planning perspective to address that concern? Maybe do it a little differently. Levers you can pull. What's your thought?
I think there's a financial and an emotional component. These always go together. One is you really want to make sure you're set up and understand what is likely to happen to your portfolio when we encounter these down markets, which are part of history. It's part of the experience, so that you don't really have major surprises. Sometimes we forget what that can be like, and it's worth reviewing that and understanding that and making sure that you are setting up your portfolio in a way where it's not going to behave in a way that's going to keep you from sleeping. So that's important. Your asset allocation, your cash reserve, these sorts of things should all be worked out yourself, or whether you work with a planner, or however you're going about it. That's one of the key elements of having a plan. The emotional side is more difficult, and I would say this is, at the end of the day, we're emotional beings. Understanding and having some humility around what kind of risk we can really accept, meaning what kind of drawdown can we be okay with, And as they say in skiing, not getting over the tips of your skis, making sure you're not getting overly aggressive, and just admitting that and being okay with that. That's important. We may like to be different than we are, but end of the day, that's not going to serve us well when we enter tough markets like that.
I love this, Mark, because I think a lot of people, when they think of financial planning, they think of, putting information in a tool, getting this thing on the other side that says you're going to be okay or not. And you don't really necessarily always run through the different scenarios. And I love this idea of really digging into not the worst case scenario, but almost like the most predictable scenario, which is, the markets are going to go down at some point in time, exactly when you might not want them to. And let's look at what's happened in history around that topic, how you feel about it.
Look, it's fairly easy to get a long-term plan that's successful, but we have to live through the short term, right? To get to the long term. So what do we do to make sure we make it through the short term stuff, essentially, to get to that long-term success? That's what's really important.
Oh, that's the part that I missed. You're right. So it's almost like navigating the short term, not as an accommodation, but as just a fact. Like, you're going to feel a particular way, so let's try to avoid feeling that way so we don't react. Okay. Love that. One thing we like doing on this podcast, Mark, we like doing a lot of things on this podcast, but one thing we really like is telling our audience what mistakes you've seen in this category of 1 to 2 years out from retirement. What's a key mistake that you want to share with everyone?
Well, yeah, and we just kind of talked about it. How do we make it through the short term? So one of the key mistakes, and this happens not just near retirement, but as we're saying, with bad sequence of returns risk, can be critical. And that is to focus and have more in our minds what has happened recently, and to make decisions more based upon that rather than understanding kind of longer term. And right now is a good example of that. We've had 3 years of the market fairly going straight up. It's been a few years since we had a bear market. Now, 3 years in certain perspective is not very long. But sometimes as humans, we kind of forget it's in the back, mirror, the rearview mirror, and we're kind of thinking, oh, here's how's everything going.
Forgetting, Mark. I like forgetting about the downturn.
Yeah, exactly. We don't want to forget about 2022 and 2008, 2009.
That's right.
But look, this stuff is going to happen again at some point. That's part of the process, and that's okay. But what naturally happens as a mistake is that we anchor on that. And this could be where we start to think we're maybe more aggressive than we are, because we've kind of forgotten what that means on the downside and risk, and we can get over the tips of our skis. Or the opposite can happen, and that is you may be retiring right after 2022, and a lot of people probably retiring right up then are looking at, hey, when the market's doing so poorly, then may underinvest and miss out on the normal sorts of gains they need and should have in their portfolio. So anchoring short term like that can be a big risk for people. And it's hard not to do that, essentially. We always want to look at longer term and understand what that's like, and think about, longer term in history and also into the future.
So our listeners like to dork out with me a little bit, Mark, on this topic on behavioral finance terms. You mentioned anchoring, right? So, looking at something like a data point or a set of information that feels relatively salient or, right in front of your face, and making decisions based on that. So there's part of what you're saying in that, to your point, where, the markets have been going up and up and up. And so I'm going to anchor on that to kind of define how comfortable I am with risk. The other one that you're mentioning is something called recency bias, which I know you and I have talked a lot about, which is what happened most recently is going to create that anchor for me. So these are big watch items, to your point, with investors. And I like that kind of two-pronged view, which is you don't want to anchor too much on the past if markets have gone up or down, because it's going to affect your future ability, or your perceptions of your future ability to expose yourself to risk, which actually might, one way or the other, damage your investment plan.
Yeah.
Either being too conservative or too aggressive. And that's where professionals can play such an important role in helping you kind of zoom out, right? And provide that bigger picture. So I love that.
A broader perspective becomes very important. Absolutely.
So with that, we've covered a lot of ground, Mark.
Yeah.
So let's hop in to close out the podcast with another thing we like to close with, which is, what's one thing that you think every listener focused on this podcast, maybe they're going to talk to a friend who's in this phase. Maybe they're going to talk to their spouse or a partner to our conversation. If they're entering that phase or they're in that phase themselves of 1 to 2 years out from retirement, maybe it's about them.
Yeah.
What's one thing that people should do right now?
I think the key is, especially now in that circumstance, frankly, at any time, what you want to do is make sure you are stress testing your plan and understanding what that's going to behave like during that time. And you gain comfort with that. That's the key element. If you can do that, you're likely going to be great.
I love that. Well, Mark, thank you. And in that, context, it's interesting. A lot of us all like to focus on the best outcomes and, the most positive things. And what you're saying that I hear is actually, if you kind of take yourself when you're not in it through the negatives, it'll actually help you be more in that zone. If those negative things end up happening, you can actually be more positive about your future. Am I hearing you right?
I think that's right. One way to say it is take care of the risk and the returns will come, essentially.
Love it. All right. I'm going to quote you on that one.
All right.
Take care of the risks and, the returns, you can really enjoy them on the other side. So really great, Mark. Appreciate you as always. Before I formally close this out, any last words for our audience?
No, I think that's it. I appreciate spending the time with you, Michael. And, when I eventually retire, which is a long ways off, I'll be calling you even after that. So I'm not giving up all my friends through work. I'll be calling you up. You probably won't be answering the call, but that's okay.
Well, I'll be out in Northern California soon. So I look forward to getting it together with you in person, Mark. And thank you again for sharing your wisdom with our listeners.
You bet. All right, Michael. Thank you very much.
That's everything we have for today. This has been Money on Your Mind. A big thanks to financial planner Mark Palmer for joining me, and we'll be back next Wednesday with a new episode. Subscribe to the show on Spotify, Apple Podcasts, or YouTube so you don't miss it. And hey, if you leave us a rating too, we'd really appreciate it. I'm Michael Liersch from Edelman Financial Engines. Talk to you next time.